We have Robert Schein, who is the CIO of Blanke Schein Wealth Management, joining us from Palm Beach with his thoughts. Robert, good to have you. Thank you very much for your time. I want to understand whether or not the market could be in for a late quarter rise, a late end-year rally, so to speak. Because right now, of course, you know, the last couple of days have been a little wary for the markets, a little cautious for the markets.
I think that's how we started the week, but that's not how we're going to end the week. Essentially, we're going to get some more information on the employment picture in the United States tomorrow. But when we started the week, I think investors and traders were anticipatory of the Federal Reserve as it relates to a pause, a pivot, and that obviously didn't happen, and that deflated the last 2 days of trading as a result of that. So tomorrow, all eyes, especially the Federal Reserve, are on the data report that's going to come out, and then ultimately the CPI report that comes out next week. We also have next week our elections, and so we're going to get some certainty one way or another, but that's actually good for the opportunity for the equity markets. And again, you also have buybacks that kick in after earnings season. So it's a mixed bag. There's a potential. I think it feels like the market wants to, but what the Fed said, push the market lower.
Yeah, and you know, you spoke about midterms coming up next week, and we were discussing about how a gridlock has typically been comfort for the markets. Do you think that that could build the case for a year-end rally?
Historically, when you get to a midterm cycle, if you look at the numbers from the S&P 500, it's always a great time to actually be invested. Historically speaking, markets actually have a relief rally as a result of that. So we could see that setup. Again, a lot is data dependent, even though the Fed didn't say that. Ultimately, that's where we're setting up right now as it relates to the job number. If the job number comes in, that the U.S. economy is still strong, that just sets into December all the questions. Does the Fed raise? If so, how much? Is it 50? Is it 75? And then the guessing game starts once again. And then the equity market, specifically, let's say technology, is pressured.
Okay, Robert, so all things considered, you've got the buybacks, let's say $5 billion a day, or Goldman, $20 billion a week, however you want to swing it in terms of up until the end of Q4. You've got the tax loss selling, you've got the impact of any kind of potential upside coming through from the midterm elections. You've also got the prospect that the 10-year paper could continue to track higher as we do continue to see this front-run futures just popping up. I believe they're at 5.14% now for May. So what's your base case? Are we going to see downside playing through into 2023, which is, to be fair, at an EPS right now of $2.32, which is highly unlikely? Or is there going to be anything that can, any kind of catalyst that can see that upside that Tani was asking about earlier?
So let's just look at the earnings per share. Right now, markets are below the priced in, or sort of the expectation of 230 on the S&P, 233, depending upon as we look at 2023 S&P earnings. That being said, that's what the market's trying to factor in. They're trying to guess what the Fed's going to do. They're trying to factor in what the CPIs looks like. And they're also trying to factor in what earnings look like. If we look at this last earnings report right now, they're below the 5-year average as it relates to the earnings that are being reported by the S&P 500. But they're not deteriorating. And that's sort of the quandary that everyone in terms of the investing class is wondering. So the question as we get to the first quarter next year, do earnings actually fall off a cliff? Do they go down from 233 to 200, which would put the S&P in the 3,000 range to 3,300? It's entirely possible that the price of the index hits that, but not the earnings. So that's very important because...
But how are you positioning, Robert? What's your bet? Because obviously you need to be positioning for that now.
Yeah. So in the short term, so as an example, we always use volatility as an opportunity. In fact, you make the most money in a bear market, you just don't realize it. And so more importantly, it's important to not make short-term or have that short-term bias impact your future retirement. So what we're looking at is taking advantage of opportunities. Again, in the cash, it's not cash, it's T-bills right now that are over 4%, and we're hiding out, but we're also taking advantage of names that are quality names that will actually make it through a recession, which we believe we could see a recession in 2023, as well as the market maybe to bottom in the first quarter of 2023. But at the end of the day, the Federal Reserve's closer to the end of tightening than actually the beginning of it, and the accelerated pace they've done this year is at historic portions.
Right. Robert, I want to also understand what's happening to the 60-40 allocation for between equities as well as debt.
So earlier this year, in the middle of the summer, 60-40 had the second worst performance since 1931. Right now, it's about where 2008 lies in terms of a total return portfolio. And actually, you're seeing knock-on effects globally, because even some of the pensions in Europe, specifically the UK, were the 60-40 portfolio. Bonds in stocks are not supposed to be positively correlated, and they actually are. So that's why you want to have alternatives in the asset class and essentially start paring back your fixed income. We have at Blanke Schein Wealth Management for our clients, we've added alternatives, we've added some hedges, but at the end of the day, at the beginning of this year to now, it always seems to be never enough, because everything's been down this year.
Everything has been down this year. Down for how long, you think, Robert? I mean, yes, okay, fine. So we've made the case that there could be reason for the markets to rally from here, but they could also equally, or I don't know which way does the probability work on that front, for the markets to stay on, to just labor along these levels for a lot of these stocks.
Well, look, no one can call the bottom, and we're not going to try to call the bottom. We're not going to try to catch the bottom. But we're going to use sound strategies that we do know, which is the dollar cost averaging. Take advantage of, if we're sitting here having this conversation a year from now, we're going to be looking at some great opportunities that have been missed if we don't start taking advantage of them by being disciplined and take them as they come with quality businesses and quality opportunities. Again, let's put it this way. Warren Buffett's been backing up the truck this year, $57 billion in terms of capital he put to work, which is more than the great financial crisis, 2008, 2009, combined. So he sees value right now. I think when a great investor like Warren Buffett sees value, right now might not be a bad time to start dollar cost averaging into some companies. Again, I don't know when the bottom is. I don't know where it is. But I do know that when it happens, it'll happen very quickly. And then we can see a return to sort of a bull market. And all bear markets end.
And we'll talk about some of those ideas, and one that is perhaps intrinsically linked with the great Warren Buffett, with you after this break. So stay with us. That's Robert Schein, Street Signs. We'll be right back in 2 short minutes. You're back on the street, and we're back with Robert Schein, Blanke Schein Wealth Management, joining us from Palm Beach. And now, before the break, we were talking about Warren Buffett and some of the investments that he has made, but we didn't let the audience know which one. And I was alluding to Occidental Petroleum, because that's a company that you indeed like. Now, in terms of the oil industry moving forward, though, do you think that we're at levels that the prices are too toppy, or do you think there's still further upside? Because the reason why I'm asking is, if someone buys this today, are they buying it for the dividend income, or are they buying it with the expectation that they could potentially see some cap gain whilst at the same time getting that dividend yield?
Yeah, so Occidental Petroleum, very specifically for the viewers at home, if they don't know, it became a top 10 holding, closely getting to a top 5 holding for Warren Buffett and his Berkshire Hathaway investment earlier this year. Again, as I said before, he's backing up the truck. In fact, energy is, if it's not in your portfolio now, it actually should find an allocation. If you look at energy respect to the S&P 500, energy's contribution is only like 6% relative to, let's say, technology, which is close to 38%, depending upon how you look at it. So there's a major imbalance in terms of everyone's portfolio, including the S&P 500 index. So what you want to do is take the opportunity to rebalance, and if you don't have energy, add to it. Now, your question to me was, hey, listen, energy has had a run year to date all across the board. Do we get in now? And if so, how do we do so? So what we're doing is we're dollar cost averaging in, as I said before, and you're scaling in, because we believe this is not a short-term transition. Long-term, if you've seen any sort of transition from a bull market, from a bear market to a bull market, the leadership changes out of a bear market. And so technology was the last leader in, and we believe that energy, or maybe industrials, could be the leader out. We're seeing industrials actually perform very well as well. But with Occidental Petroleum, they don't pay much of a dividend, but their sector positioned, their strong growth, even on the earnings side. So again, earnings next week, if you see some pullback based upon basically the market pulling back, or even earnings expectation, meaning the growth isn't as high as it should be, it's an opportunity, it's a good entry point to add Occidental Petroleum to your portfolio.
Right. Wells Fargo, Robert, is the idea behind it more to do with the fact that they're focused on retail and have a strong retail book?
Actually, the $2 trillion business that hasn't been able to get out of its way for 2 decades brought in a new leadership team in 2019. In fact, they brought in 90 executives from outside the company because they knew they had to change the culture internally. That being said, with the opportunity with that size and scale and the new leadership team, even if you look at the stock year-to-date performance, it's outpacing all of the other financials in its class. So with the net interest margin, meaning the interest on the banks and the net opportunity to the cash flow, as well as the opportunity to find cost savings internally, and being a sharp management team, strong leadership on a go-forward basis, even in a potential recession in 2023, it actually has tremendous value at about a 10 PE, price to earnings ratio on a future. So the value is there, and then you're also going to get paid about 2.5% on a dividend.
And on the defensive side, Costco?
We love Costco in the Schein household. We are avid consumers of the Costco, not only at the deal that we get at the gas prices, right, but also inside the discount retailer. Next year they're going to increase their membership fee, but more importantly, here's the bottom line: Costco is there to be a price consumer on the consumer side, right? That has their name in the name of the company. Where when we are in a recession, you want them to help basically put pressure on all of their internal suppliers. Therefore, we know we're going to get the best deal, and they have the best sense on the consumer of what we're going to, let's say, absorb the higher prices that are passed on or not absorb the higher prices. So Costco's on your side, and ultimately, if you dollar cost average into Costco, in about a year, 3 years, 5 years from now, you actually could be shopping at Costco for free, as we are at the Schein household, because of the appreciation of the stock if you have a longer term view.
And what are you avoiding, Robert? Because we talk about, and these are all very defensive stocks, and you don't necessarily have to say big tech, because we've basically covered that off when it comes to you saying that they're not going to be the leader moving out. But is there anything in particular that you'd be avoiding other than, say, for example, those big tech names?
So besides big tech, I think, right now it's the consumer sort of cyclicals or the internet names that have, they were the pandemic darlings. We've never invested in them for our clients. We've avoided them, so we don't have to worry about those, particular names being, so far down. But at the end of the day, this is a great opportunity to look at your portfolio, rebalance it, take advantage of the tax loss selling, and therefore you can use that for either this year or future gains. But add some energy, as I said before, and add some opportunities like, let's say, the financial services sector or even Costco, as we talked.
Right. I'm loving the stock talk conversation, the stock talk that's going on. So give us one more name that you like or that you've added to the portfolio or have recommended to clients recently. So
bonds are sexy again. If you look at the Treasury market in the U.S., even the T-bills or even the 6-month, you're getting over 4%. So, you get paid while you wait. And right now, if the Federal Reserve continues on this pace, we just roll over and roll into higher yielding sort of U.S. Treasuries. And it's a good, safe space to be in, and it's a great spot just to hang out. So I haven't said that in a while. We've had cash on the balance sheet for clients for quite some time. Clients have said, Rob, why haven't you invested it? We said we've been waiting for the Federal Reserve to get to a level where it's attractive, and now we see Treasuries as an attractive place on the short end of the yield curve to hide out as the market and the economy sort of figures things out going forward.
Yeah, 3-month bill going at 4% plus. That's mouth-watering. Thanks very much for joining us and giving us that perspective. Really enjoy having you on the show, Robert. Thank you very much for your time.